I was sick of losing trades, watching my stop losses hit right as the market turns. But that all changed once I learned about fair value gaps. My entries improved and I found myself catching explosive moves. In this video, we're going to cover everything you need to know to take full advantage of fair value gaps, as well as various examples on how you can use them to profit in trading any asset. Fair value gaps are imbalances on the chart that are confirmed with a 3-candlestick pattern. For a bullish fair value gap, the first candle's high does not overlap with the third candle's low. This visually creates a gap, and typically, the market will retrace to fill this gap either partially or completely before continuation of the trend. Now, the reverse is true for a bearish fair value gap. The first candle's low does not overlap with the third candle's high, again, leaving an imbalance on the chart. These gaps act as magnets. The market tends to be drawn to them, which we can also refer to as a draw on liquidity. This can be our target when we're looking to take profit. You can also use them to enter a trade after a valid setup has formed. To differentiate between a bullish and bearish fair value gap, we're going to call them busy and SIBI. A busy stands for a buy-side imbalance with a sell-side inefficiency. This is a bullish fair value gap in an area where we might look to take a long position. A SIBI stands for sell-side imbalance, buy-side inefficiency, and this is the bearish version of a fair value gap. Typically, we would use this to look for a short position or for the market to trend down. Now, most people don't know this, but there are actually 3 different levels of fair value gaps that you can look for to take better trades. The first is IO Fed, which stands for Institutional Order Flow Entry Drill. This is when price barely reaches into a fair value gap before expanding away from it. It's best used when there's heavy momentum in the market with large, energetic candlesticks. Next, we have CE, short for Consequent Encroachment, which is the midpoint of an inefficiency or gap. When price returns to a gap, it doesn't always fill the entire imbalance. It can just barely enter the area and then reverse, or it can continue to trade to the midpoint before changing course. Lastly, we have the FVG fill. This is when price retraces and completes the fair value gap. Now, when this happens, one of 2 things will result. It can respect the level and create a large wick, rejecting and moving away from it. Or it can completely disregard the gap. Because there are so many possibilities with fair value gaps, we use these 3 levels to help us monitor price action. Now, I understand this is a lot to digest in a video, so I think the best way to help you understand fair value gaps and start putting them into your trading is by some visual examples. Right now, we're looking at the gold chart, and what we can see is that it's making higher highs and higher lows. This is showing us an uptrend. In this case, we'll be looking for a long opportunity, and we're going to use fair value gaps to help. Here we can see the market creating a bullish fair value gap. We're going to mark it out on our chart along with the consequent encroachment. Once price trades into the area, we're going to zoom in to a lower time frame, like the 5 or 15 minute. Looking closely, we can see that it is retraced to the 50% level, or the consequent encroachment. Now, there'll be 2 ways to enter this trade. We could look to enter after a candle close above the most recent swing high, and we can aim for a 1-to-2 or 1-to-3 risk to reward ratio, which will define our stop loss and take profit. Or we could enter after a bullish engulfing candlestick. We can place our stop below the candle and take a higher risk to reward ratio. At first, this practice will be unintuitive, and even after mastering this concept, you may find it tedious to manually mark each one on your chart. Luckily, there are multiple free indicators on TradingView that can do this for you. I personally recommend Lux Algos, which you can find on the Indicators tab at TradingView.com. Using these will automatically mark them on your chart, doing the work for you. One simple way to trade with just this one time frame, preferably the 15-minute or so, is to wait for the market to take out a high and then expand to the other side, breaking the low. Once the gap has been created, it will be displayed by the indicator directly on your chart. We can enter the short on the first touch with our stop above the fair value gap, and we can target the swing low to the downside. Hopefully this video has helped you understand how to use fair value gaps and how to incorporate them into your trading a little better. If you know a trader that might benefit from this video, please share it with them.